Join me as I dive into my own investment portfolio to see if it's truly diversified or if I'm just putting all my eggs in one basket. When it comes to investing, having a diversified portfolio is key to achieving long-term success. It's a concept that's often talked about, but rarely understood. In essence, diversification is about spreading your investments across different asset classes to minimize risk and maximize returns. It's like having a puzzle with many pieces. Each piece represents a different investment, and when put together, they create a complete picture of a well-balanced portfolio. One of the biggest mistakes investors make is thinking they're diversified when in reality, they're not. They might have a bunch of different stocks, but if they're all from the same industry, they're still at risk of losing everything if that industry takes a hit. Or they might have a bunch of different mutual funds. But if they're all invested in the same asset class, they're not really diversified at all. This lack of diversification can lead to increased risk and even financial disaster. I've seen it time and time again, where investors think they're doing the right thing, but in reality, they're just playing a game of financial Russian roulette. Another pitfall is putting too much faith in a single investment. I've seen investors who've made a killing on one stock and then proceeded to put all their eggs in that one basket. Newsflash, past performance is not a guarantee of future success. No matter how well a stock has performed in the past, there's always a chance it could tank in the future. And if you've put all your eggs in that one basket, you're going to be left with nothing. Investors also often underestimate the impact of fees on their portfolio. They might think they're diversified, but if they're paying high fees on each individual investment, they're eating away at their returns. It's like trying to fill a leaky bucket. No matter how much money you put in, it's all just going to drain away. And finally, investors often fail to regularly rebalance their portfolios. They might set it and forget it, but the problem is that the market is constantly changing. What was a great investment last year might not be so great this year. And if you're not regularly rebalancing, you could end up with a portfolio that's way out of whack. When it comes to building a well-balanced portfolio, there are several asset classes to consider. Stocks are a great way to invest in individual companies and potentially earn high returns. Bonds are a lower-risk option that can provide a steady stream of income. And then there are alternative investments like real estate, commodities, and even cryptocurrencies. Each of these asset classes has its own unique characteristics, and when combined, they can create a portfolio that's truly diversified. Stocks can be further divided into different sectors, such as technology, healthcare, and finance. This can help you spread your risk even further, as each sector will perform differently in different market conditions. Bonds can be government or corporate, and they offer a range of maturities and yields. And alternative investments can add an extra layer of diversification, as they often perform differently than traditional stocks and bonds. But how do you know if your portfolio is truly diversified? One simple method is to use a diversification tool or calculator. These tools can help you visualize your portfolio and identify any areas that might be lacking. You can input your investments and get a report that shows you exactly how diversified you are. It's like getting a snapshot of your financial health. Another method is to use what's called a core and satellite approach. This involves allocating a certain percentage of your portfolio to a core of diversified investments, and then adding satellite investments that are a bit riskier but offer higher potential returns. This approach can help you strike a balance between safety and risk-taking. You can also work with a financial advisor who can help you assess your portfolio and provide personalized advice. They can help you identify areas of risk and opportunities for growth, and create a customized investment plan that's tailored to your needs. Having a diversified portfolio is crucial in today's volatile market. It's like having an insurance policy against financial disaster. By spreading your investments across different asset classes, you can minimize risk and maximize returns. It's not a one-time task, but an ongoing process that requires regular monitoring and rebalancing. Thanks for watching, and I'd love to hear from you in the comments. What's your strategy for diversifying your portfolio? And if you're interested in learning more about investment strategies, be sure to check out my next video. Please click on the link below to subscribe.